Okay, so in this class, we are going to talk about fraud, internal control, and cash. Specifically, we are going to begin with talk about fraud and the principles of internal control. And then we are going to talk about the application of internal control on cash. And lastly, we're going to talk about the reporting of cash. So first of all, what is fraud? The definition of fraud is it is a dishonest act by an employee that results in personal benefit to the employee at a cost to the employer. And this is the definition of fraud. Why does fraud occur? So the three major contributors to fraud. First of all, in order for a fraud to occur, the person who commits fraud needs to have opportunity. So opportunity is one of the most important contributors to fraud. And then the person who commits fraud probably has some motivation. And one of the major motivation is financial pressure. The person may need some money. So that motivates that person to commit fraud if there's opportunity for that. And then also rationalization. So the person may need to feel it is justified that they commit fraud. And these three factors, those are called the fraud triangle. Examples of those three factors, so opportunity, inadequate monitoring of employee actions can create opportunities for theft and can embolden employees because they believe they will not be caught. So this is opportunity. Financial pressure, so they may commit fraud because of personal financial problems caused by maybe too much debt. This is an example of financial pressure may motivate someone to commit fraud. Rationalization, they may feel justified in stealing because they feel they deserve to be paid more. So this is an example of the rationalization. We talked about opportunities as one of the major contributors of fraud. And opportunities occur when workplace lacks sufficient internal control to deter and detect fraud. Why does opportunities occur? Because there's not sufficient internal controls in the workplace. So what is internal control? Internal control is a process designed to provide reasonable assurance regarding the achievement of company objectives related to operations, reporting, and compliance. So the major point here is internal control. It is a process which is designed to detect and deter fraud. And what is the purpose of internal control? It is to detect and deter fraud, to safeguard asset, enhance reliability of accounting record, increase efficiency of operations, and ensure compliance with laws and regulations. So that's the purpose of internal control. And what are the major components of internal control? Internal control has 5 major components. So first of all, we need to have tone at the top. Top managers should make it clear that fraud is not tolerated in the firm. So this is called a control environment. And secondly, the firm needs to have risk assessment. So they need to identify and analyze the factors that create risk for the business. And they must determine how to manage those risks. So they need to have an assessment of the risk the firm has. Control activities, management must design policies and procedures to address those risks. Information and communication. So the internal control system must capture and communicate all of the relevant information as well as communicate those information to appropriate external parties. Monitoring. So internal control system must be monitored periodically for their adequacy. And we have 5 major components of a good internal control system. Each of those 5 components, those are important. But here we focus on one of those, which is the control activities. The reason we focus on control activities is because they're the backbone of the company's efforts to address fraud, to address the risk it faces. So what are the principles of control activities? Control activities have 6 principles. First of all, establishment of responsibility. So control is most effective when only one person is responsible for a given task. And this is easy to understand. If more than one person is responsible for the same task, it will be hard to distinguish. If something goes wrong, we cannot tell who's the one who's responsible for that. So we need to have an establishment of responsibility. Segregation of duties. So this is out of similar reasons. We need to make one individual responsible for related activities increase the potential for errors and fraud. Documentation procedure, everything needs to be documented. Physical control, so for example, safe box with store cash, we need to have some physical controls in place. Independent internal verification, so this is where internal auditors come into play. Internal auditors are basically the employees who evaluate the effectiveness of the firm's internal control system. Human resource control. So sometimes firms are going to purchase insurance against saved by employees, and this is called bonding. And rotating employee duties require employee to take vacations and thorough background check. So all of those are human resource controls. And those are 6 principles of control activities. So the last thing I want to mention about internal control is SOX Act of 2002. And I don't know how many of you know this, but in the year around year 2000, there were some very big frauds coming up for some of the very well-known publicly listed firms. One of those was Enron. Enron used to be one of the biggest US publicly listed firm. And then it turned out that the management of the firm committed fraud, and the firm ended up going into bankruptcy. There's some other known case around that time as well. So as a result, that the Congress passed this act, and effective in 2006, according to this act, all of the publicly traded firms are required to implement and report internal controls to SEC for compliance. And here are some of the rules under SOX. So for example, all of the publicly traded firms are required to maintain adequate system of internal control. Independent outside auditors must attest to the accuracy of the internal control system. So all of those are new. They came out because of the SOX Act. Before SOX, auditors doesn't need to attest to the adequacy of the firm's internal control system. And there was no requirement on the firm's internal control system. So all of those came out because of SOX. We have talked about internal control, which help firm to deter frauds. And cash is the asset which is most susceptible to fraudulent activities. The reason is cash is very liquid. You can use cash to purchase everything, and it is also very easy to carry. So imagine that if someone works for Target, and it would be so inconvenient if that person wants to steal, for example, box of yogurt from Target, or to steal a mirror from Target. So, but instead, if that person wants to just steal some cash, it will be much easier. So cash is the asset which is most susceptible to fraudulent activities. And then now let's look at how firms can apply internal controls to cash. So there are 2 aspects to cash. One is cash receipt. The other is cash disbursement, the receiving of cash and the payment of cash. How can firms apply internal control to cash receipts? So again, we have the 6 principles, and all of those can be applied to the internal control to cash receipt. One example is over-the-counter receipt, and here is a procedure which is developed according to the 6 principles if a firm has any over-the-counter cash receipt. So if you look at this procedure, there's actually 4 parties involved here. The clerk who received the cash, cashier, the supervisor, and the accounting department. And clerk is the one who received cash. So if you go to, for example, Target, the clerk scanned the items that you purchase, and it may you may pay Target in cash, and then the clerk is going to receive cash, put it in the box. At the same time, that register is going to the transaction is going to be recorded in the cash register tape. So the clerk only deals with the cash. It doesn't deal. It has no access to the cash register tape, so that the clerk cannot alter the cash register tape. And then the clerk at the end of the day is going to send the cash to cashier, and cashier is going to count the cash and prepare a deposit split, and it's going to deposit the cash into the bank. So the clerk and the cashier are the ones who deal with cash. On the other side, the supervisor doesn't deal with cash at all. At the end of the day, the supervisor is going to remove locked cash register tape. So it's going to take the cash register tape out, and then it's going to send it to the accounting department. Accounting department, they have the cash register tape. They also have the deposit split from the cashier. So the accounting department can compare the two. If the clerk wants to steal some money, then the amount of money on the deposit split cannot be agreed to the amount of money which is recorded on the cash register tape. And this is very easy to check for the accounting department. The accounting department will notice obvious difference between the two, and then it can go ahead and investigate what is causing the difference. And at the end of the month, the bank is also going to send the firm a bank statement, and the accounting department can do that bank reconciliation, which we are going to talk about in a minute. So the accounting department can compare the record by the bank with its own record to see whether there's any difference and what is causing the difference. So this is a very simple and basic internal control over the over-the-counter cash receipt. And if for some reason the cash register tape, the number on the cash register tape does not tie with the number on the cash deposit at the bank, the firm can go ahead and investigate what is causing the difference. But if there's something wrong with the for example, the cash deposit at the bank, the firm can adjust that number and then into an account called cash over and short, and this is an income statement account. So this is an example of internal control for over-the-counter cash receipt. And then with regard to the cash disbursement, the payment of cash, we can also apply the 6 principles. And then one example is the voucher system controls. Voucher system is basically a network of approvals. Whenever the firm is going to pay out some money, it needs to go through a network of approvals by authorized individuals. So approvals is very important. And then the procedure is we start from authorization to occur an expense, and it ends with the issuance of a check. So a voucher is an authorization form. We start from the authorization. We need to fill in the appropriate information on the face of the voucher, the authorization form. And an employee in the account payable department is going to record liability related to the voucher and file it according to the date on which it is to be paid. So it is to be paid. The company issues and sends a check on that date and stamp the voucher to be stamp the voucher with the word paid. So the paid voucher is sent to the accounting department for recording. This is a very simple and basic voucher system control, which deals with the cash payment. So most of the time, firms safeguard cash by using bank account. And when they make payments, they write a check. However, payment by check is not always practical. And examples for this is, for example, if the firm want to pay some postage, it doesn't always make sense to write a check for that. And if the firm is going to buy some working lunch, doesn't always make sense to pay by check. Taxi fares doesn't pay by check. So how do we deal with it in this kind of situation? And a common way to handle payment in this situation is to use what we call a petty cash fund. So this petty cash fund, basically it involves three major events. The first event is when the firm establishes this kind of fund. And then when the firm make payment from the fund. And then after a while, when the amount, the balance of the fund goes below a certain amount, the firm needs to replenish the petty cash fund. So let's first look at the establishment of the petty cash fund. To establish the fund, the firm needs to issue a check payable to the petty cash custodian for the stipulated amount. And the general entry for this is to debit petty cash, credit cash. So an example is the firm decides to establish, for example, a $100 fund. And we debit petty cash 100, credit cash 100. And if later the firm decides to increase the size of the fund to 250, they only need to debit petty cash for another 150 and credit cash for another 150. So this is the first event when the firm established the fund. The second event is when payments are made out of this fund. What do we need to do? Actually, for accounting wise, we don't need to do anything. So every time when the person who take care of the petty cash fund is making payment out of the fund, they must document it in a petty cash receipt. And this is how this receipt looks like. So this is the date of the payment, the amount, whom it is paid to, and for what. And then the who approves it and who received the payment. So this is just a very simple, typical petty cash receipt. Every time payments is made out of the petty cash fund, we need to have such a receipt. And then the petty cash custodian keep the receipt in the petty cash box until the fund is replenished. At any point in time, the sum of the petty cash receipt in the box and the money in the box should always equal to the established total sum amount of money. And in the previous example, it was originally 100. However, for accounting department doesn't need to know about it. Accounting is not going to do anything with regard to this. It's just too immature for accounting department to care about every little payment made out of the petty cash fund. And then the third event is whenever the money in the fund reach a minimum level, or it is at the end of the accounting period, the firm needs to replenish the petty cash fund. Example is, so if the firm's petty cash custodian requires a check for 88, because the fund contains $12 cash, and the petty cash receipt total is, so as you can notice here that this $1 difference. And then, so the petty cash receipt total is postage 44, freight out 38, and other expense $5. So those are the expense that were paid out of the petty cash fund that the firm has a record of. But for some reason, there was a $1 difference, which is somehow missing. And the firm is, I mean, if it's just $1, probably it's not worth investing. But the firm also has a record of this $1 difference. If that amount gets to be accumulates to be very big, the firm is definitely going to investigate about it. But for accounting purpose, what is the general entry? So for when the petty cash fund was replenished, that is when the firm records those expenses. and it is going to record a decrease in cash. And then the difference is going to be recorded as either as a cash over and short. So this, as you maybe remember from what we talked about 5 minutes ago, this is an income statement account. So this is the journal entry when the firm replenished the petty cash fund. And basically here, when those cash are actually paid out, which was in the previous step, the firm doesn't make any accounting journal entry. It is only when the petty cash fund is replenished, the firm needs to make a journal entry to record a decrease in cash. So firm use petty cash fund to make small payments, but in most of the other situations, they are going to use bank accounts. And what are the benefits of using a bank account? So using a bank account have two major benefits. It is going to minimize the use of cash that must be kept on hand, and so that the firm doesn't need to keep all of the cash on hand. It also facilitates control of cash, because when the firm is having a bank account, the bank is going to keep a record of the increase and decrease in that account. In addition to that, the firm is also going to keep its own record. So it's like a double recording system. And at the end of the financial reporting period, the bank is going to send its record back to the firm, and the firm can compare the two, its own record with the record by the bank, and to check whether there's any difference and what is the reason for that. So actually, the record kept by the bank, usually, actually in most situations, it's not going to be the same as the record kept by the firm. And the process of comparing the bank's balance with the company's balance and explain the difference, this process, it is called bank reconciliation. So you may ask why, what is going to cause the difference between the two, the record kept by the bank and the record kept by the firm? The difference can come from two sources. The first source is there may be a time lag that prevents one of the parties from recording the transaction. Actually, this happens very often. And then the other is one of the parties may make an error. So those are the two major causes. And so how do we do bank reconciliation? We have the bank statement, which is the statement issued by the bank, and per book is the firm's own record of the increase and decrease in the cash account. The bank statement. So bank statement, sometimes it doesn't really include the true cash balance that should be recorded. Why is it the reason? So sometimes the firm may have received a check, but it hasn't been deposited yet. So it is called deposit in transit. And sometimes the firm may have issued that check, but that check hasn't been cashed yet. This is called outstanding check. So those are the two major situations that may cause the bank statement balance to be inaccurate. And bank may also have some errors. And with regard to the firm, so the EFT transaction, EFT collections, what is EFT? We're going to talk about in the next slide. But EFT collections, so those are deposits that has been already been received by the firm's bank. But for some reason, the firm is not aware of it yet. NSF bounced check for similar reason. This is an empty check, so it is bounced, and then the bank is going to deduct that amount from the firm's bank balance, but the firm is not aware of it yet until before it received the bank statement. It didn't know that that check is an empty check. Sometimes service charge and other payment. So the bank may charge the firm some service fee, and the firm does not know about that service charge until it received the bank statement. So those are the situations which may cause the firm's book record to be inaccurate. And of course, the firm may make some errors as well. And then So we just talked about, so this is again what we just talked about. If you start from the bank statement, we need to add the deposit in transit and take out the outstanding check and plus or minus any bank error. That is going to give us the correct cash balance. If we start from the firm's book, we need to add all of the deposits, other deposits that the firm hasn't recorded yet. Take out the NSF check and take out the other payment and add or plus any company error. That is going to give us the correct cash balance. And those two balances needs to agree. If they don't agree, there's something wrong and we need to do further investigation. And specifically deposit in transit, those are deposits reported by the firm that have not been recorded by the bank yet. Outstanding check, those are checks issued by the firm that has not been received paid by the bank yet. And other deposits, so one of the typical one is EFT collection, and EFT basically stands for electronic funds transfer. So those are disbursement system that use electronically transfer cash from one location to another. NSF check, so those are checks not paid by the bank because of insufficient fund in the check writer's bank account and other payment. So we just talked about bank reconciliation. And here's an example. So we have the bank statement here. And as you can see on April 30th, the statement balance, the balance of the firm per its bank statement is 15,908.45. And on the same date, the firm's book show a cash balance of 11,709.45. So obviously those two balances doesn't agree. So in order to do the bank reconciliation, we need to investigate what is causing the difference. And the firm find out that to reconcile, there are some reconciliation items for the bank. So for example, there's some deposit in transit. The deposit was made on April 30th, but it has not been received by the bank until May 1st. And this is only a timing difference. Outstanding check. So those checks that has been issued, but hasn't been cashed yet. Reconciliation items for the book. Reconciliation items for the book, for example, there's some unrecorded electronic receipt from customer on account. And the firm only know about that electronic receipt when the firm received the bank statement. For some reason, the firm was not informed of that receipt before it received the bank statement. And also, some return NSF check, so some empty check that needs to be the amount needs to be deducted from the firm's cash balance. Some debit and credit card fees, service charge, so those charges, and there's some error which was made by the firm. So based on the above information, we need to prepare the bank reconciliation, and we also need to record the related adjusting entry. The purpose of those adjusting entry is to adjust the balance per book into the correct cash balance. So you can pause your video for now and please spend 5 minutes. Try to work on it on your own. Prepare a bank reconciliation and record related adjustment and adjusting entry. And you can pause your video for now. So let's look at this bank reconciliation. First of all, cash balance per bank statement. So this number is taken from the bank statement. It's taken from here. And we also need to have the cash balance per book. And this number is given here. So we start from, on one side, we start from the bank statement, the balance on the bank statement, and we add the deposit in transit. We take out the outstanding checks. So we take out the outstanding checks balance from the bank statement balance. And then we're going to have this number. This is adjusted cash balance per bank. And on the other side, we start from the cash balance per book, and we add electronic funds transfer received, adjust for any errors, and take out those kind of bank charges and NSF check balance. And this is the amount, the adjusted cash balance per book. And those two amounts should agree. If they do not agree, there's something wrong. So we need to do further investigation. There's probably some other items that was left out of reconciliation. And then we need to include those items as well. So after we have made such a bank reconciliation, the next step is to make journal entries, because we know now that this number, this is not the correct bank cash balance. And this is actually the correct cash balance. And in order to adjust the firm's cash balance from here to here, we need to add those items and take out those items. So how do we do that? We do that through journal entries. First of all, we record collection of EFT by debit cash, credit account receivable. So EFT, this used to be account receivable for the firm. And now the customer pay the firm back in cash through an EFT transfer. And then so the firm debit cash, credit account receivable. Book errors, whatever book error is going, we need to adjust for that. NSF check. So what is happening here is when the firm receives the check, it makes the deposit. And then when it makes the deposit, the firm is going to debit cash, credit account receivable. However, if it turns out the check is not, it's an empty check, so it's going to be bounced back, the firm needs to reverse the previous journal entry. And in order to do that, we debit account receivable, credit cash. Bank charge. So basically, the firm paid out in cash some bank charge, and we debit bank charge expense, credit cash. So this is about bank reconciliation. And we have talked about fraud, internal control, and how firms can apply internal control to cash. And now let's look at how cash are reported on the balance sheet. So here's an example from Starbucks 2021 10K report. And as you can see here that this item, cash and cash equivalent, so which records the firm's cash balance. And so this the account which is used to record the firm's cash balance, it is called cash and cash equivalent. So specifically, what is cash? When we talk about cash, it's very easy to think about those dollar bills, those coins. Yeah, those are definitely cash. However, there's some other items which are also viewed as cash accounting-wise. Yeah, accounting. For example, checks are also viewed as cash. Money orders are also viewed as cash. Money on hand or on deposit in bank or similar depository, those are cash as well. And what is cash equivalent? Cash equivalent, those are basically short-term, highly liquid investment that are both readily convertible to known amount of cash, and so near their maturity that their market value is relatively insensitive to change in the interest rate. So there are usually investments that matures within 3 months or less. And examples of those is, for example, treasury bills, commercial papers, very short-term corporate notes, money market funds. So those are examples of cash equivalent. And on the firm's balance sheet, usually firms are going to combine cash and cash equivalent and report those as one item, just like this on the firm's balance sheet. And as another example, here's another example. So this is an example from Delta Airline. And as you can see here that the firm report cash and cash equivalent. It also report an item called restricted cash. So what is this restricted cash? Restricted cash are basically cash that is not available for general use, but rather is restricted for a special purpose. And as you notice, you can see here that restricted cash, those are reported separately from cash and cash equivalent. Those cash, even though they are also cash, but they are not available for general use. The firm cannot use it whenever they want. So that's why they should be reported separately on the balance sheet. And examples are, as we just mentioned, Delta maintain $122 million as restricted cash, and those are collaterals to support insurance obligations related to workers' compensation claims. So even though Delta has that amount of cash, it cannot use it to do some other things. It is restricted for a special purpose. And McKinsey maintain restricted cash of $962 million to be paid out as a result of investor lawsuit. So McKinsey cannot use it for other purpose. It is restricted for this special purpose. Yeah, so this is what this chapter is about. And in next chapter, we're going to talk about receivables.